China has also, by my estimations, as a government, the People's Bank has, not the People's Bank, sorry, the People's Government, the Communist Party, has accumulated over 30,000 tons, which are not on the central bank's balance sheet. I'm informed by sources who I have found to be generally reliable that the Russians have probably got a further 10,000 tons of gold, which doesn't show on their central bank's balance sheets, because they've got two wealth funds which hold this gold, and there could well be tucked away elsewhere. Drummed into Americans' heads that gold is no longer part of the monetary system. The dollar has replaced it. And it's also been driven into the heads of everybody who would call themselves allies of America. We now accept the dollar is money, and gold is a pet rock or whatever. The gold standard is a barbaric relic, as Keynes put it. It does actually leave American citizens very, very exposed, I'm afraid, because it is propaganda, no more than that. The legal position is quite simple. It has always been that gold is money and the rest is credit. And it doesn't matter what propaganda you've had drummed into your head over the last 50 years. The law is the law. It's as simple as that. And the reason it works as a law is twofold. Firstly, it's behind everybody else's legal position. So it is truly international. It takes the nationality out of credit. The second reason behind this is that it is always credit which circulates, not money itself. Money is there to secure the value of credit. And if you detach credit from money, then it starts losing value. And you can see this reflected, if you like, in the move of the dollar, from $35 an ounce in 1971 to currently nearly 2,400. Put it the other way around, and what you're looking at is the dollar has lost over 98.5% of its purchasing power in 50 years, measured in gold. And gold is the standard. This is not Bitcoin, which is going up and up and up and up because it's being driven by speculative demand. This is real money. Its purchasing power is relatively constant. It's relatively constant in the sense that it can maybe double or halve against certain commodities over a period of time. But that's very different from losing 98.5% of its value. Very, very different. Have the gold and fly off with it. So, what's going on? I mean, it seems to me that there is a deficiency of gold in U.S. government's hands.
Continuing from the strategic positioning of China and Russia, their approach to gold accumulation reveals a significant divergence from Western practices. China's government, according to Alasdair Macleod's estimations, has amassed over 30,000 tons of gold, which is not reflected on the central bank's balance sheet. Similarly, reliable sources indicate that Russia has accumulated around 10,000 tons of gold through wealth funds that also do not appear on their official central bank balance sheets. The debasement of the US dollar is evident when comparing its purchasing power against gold. From 1971, when the gold standard was effectively abandoned, to the present day, the dollar has lost over 98.5% of its value measured in gold. This stark decline illustrates the hidden inflation and loss of purchasing power that fiat currency holders experience, a reality masked by the relative stability of dollar-denominated assets and the everyday consumer prices.
As the price of gold rises, this just brings greater and greater pressure on the US government. I mean, huge pressure. It's going to be, I think, we're looking at potentially some sort of crisis as this becomes known, if you like. But of course, China and Russia have been doing exactly the opposite thing. They are now the two largest nations by mining output. Russia just recently, but China for a considerable time. China has also, by my estimations, as a government, the People's Bank has, not the People's Bank, sorry, the People's Government, the Communist Party has accumulated over 30,000 tons, which are not on the central bank's balance sheet. And I'm informed by sources who I have found to be generally reliable that the Russians have probably got a further 10,000 tons of gold, which doesn't show on their central bank's balance sheets, because they've got two wealth funds which hold this gold, and they could well be tucked away elsewhere.
This geopolitical chess game extends beyond mere gold accumulation. It reflects broader economic and strategic policies that have long-term implications for global financial stability. China and Russia's focus on gold also signifies their readiness for a shift in the global financial order. By hoarding substantial gold reserves, they signal their intent to reduce reliance on the US dollar and establish a more stable monetary foundation that could attract other nations seeking to diversify away from the dollar. The recent trends in bond yields and interest rates further complicate the financial landscape. In Japan, for example, the yield on 10-year government bonds has been steadily rising, putting pressure on the Bank of Japan's balance sheet and the broader economy. With interest rates rising from historically low levels, many businesses that took advantage of cheap credit now face refinancing challenges that threaten their viability. This scenario is not unique to Japan, but is indicative of broader global trends as central banks worldwide grapple with rising interest rates and the resulting economic pressures. The U.S. Treasury market also faces significant challenges. Rising bond yields and increasing debt levels underscore the vulnerability of the financial system. The shift from low to higher interest rates reveals the fragility of economies heavily reliant on cheap credit. As these pressures mount, the attractiveness of gold as a safe haven increases. Investors, both individual and institutional, are likely to turn to gold to preserve wealth amid rising inflation and economic instability. Japan's financial troubles, including the depreciation of the yen and rising bond yields, serve as a canary in the coal mine for other economies. The weakening yen indicates declining purchasing power and rising inflationary pressures, which could destabilize bond yields further. Japanese investors, recognizing these risks, may increasingly turn to gold as a hedge against economic turmoil. This trend, if mirrored globally, could drive gold prices even higher, exacerbating the pressures on Western financial systems. As central banks in the West, particularly in the US, continue to print money to address economic challenges, the resulting inflation further erodes the value of fiat currencies. This continuous devaluation highlights the need for a stable store of value, a role that gold historically fulfills. The strategic positioning by China and Russia to accumulate gold while the West prints more money underscores the shifting dynamics in global finance.
So, the Asian hegemons are wholly prepared for a collapse of dollar-based credit. They have insulated themselves against this possibility, stroke likelihood, stroke certainty. Yet America, I think, and Britain, and I look at Canada, has got none at all now, sold all their gold. We're sitting here without the cover necessary. How are we going to respond to this? And I think the first sign of trouble could well be not too far away if gold and silver prices continue to rise and it starts to destabilize the bullion banking system. I think the first thing I would say is that banks have bank risk has disappeared from the headlines a bit, and that I think can probably be attributed to the decline in bond yields, the expectation that interest rates will start falling later on this year. All that sort of stuff takes pressure off the banks. It is coming back. We see that bond yields are generally rising again. They have yet to get to the levels which we saw last October. I mean, the US Treasury, 10-year Treasury, for example, I think just touched 5% last October. We fell to around about 3.75%, and currently we're looking at 4.58%, something like that. So you can see that they're on the way back up, but perhaps not in crisis territory yet. The interesting one is the Japanese government bond, the 10-year. The Bank of Japan has tried to sit on yields there and to stop them rising. Their target, believe it or not, was 0%. So it's now 1.08% as we do this interview. This is the highest it's been since 2011. So you can see that this is putting a lot of pressure on a system where there is an awful lot of debt whose value is falling. Perhaps not quite at the pace we've seen in other jurisdictions yet, but it is definitely falling. It's undermined completely the Bank of Japan's balance sheet. I think also is creating problems for zombie businesses, because when you have ultra low interest rates and businesses take advantage of it, they don't actually think that at some stage these rates are going to rise and they're going to have to refinance. That is now happening in Japan. It doesn't sound dramatic to us, the idea that, say, a major corporation has found that the rate of borrowing has risen by 1%. But bearing in mind that's probably risen from 0.25% when interest rates were negative to currently 1.5%. This is beginning to have a pretty big impact on the viability of these businesses. So the Bank of Japan, I think, is on the verge of having a developing crisis. I don't think 1.08% is quite enough to tip the whole system under, but there is no doubt that the yield is rising and will continue to rise. If you look at the yen-dollar rate as well, that is rising again. I mean, the number is rising, which basically means that the purchasing power of the yen measured in dollars is falling. We're currently about 157, I think, having hit a high recently of 160 before backing off. So that, I think, is continuing to be a real problem for the Japanese. And at some stage, if things continue in this direction, I think they probably will, then they're going to have to take some pretty strong action to try and stabilize the currency, because the price inflation effect of a falling currency is going to start destabilizing bond yields even further. And I think that, if you like, it's the first canary in the bond gold mine, or the bond mine that we're seeing. I'm talking about gold. I think I haven't monitored it, but I wouldn't be surprised if the Japanese are buying gold as well, because they must be looking at this. Japanese investors, who again are big savers, not as much as the Chinese, but they're big savers. They must be looking at this and thinking, we better have some gold, better have some silver. Probably gold more than silver.
In conclusion, the strategic accumulation of gold by China and Russia reflects a broader move to insulate their economies from the vulnerabilities of fiat currencies, particularly the US dollar. As these nations prepare for a potential collapse of dollar-based credit, they position themselves as leaders in a new financial order that values stability and tangible assets over speculative financial instruments. This shift has significant implications for global finance, as the demand for gold increases and Western nations grapple with the economic fallout of rising debt and devalued currencies. Western nations, particularly the United States, find themselves at a crossroads. The long-held belief in the supremacy of the dollar and the dismissal of gold as a monetary asset have left them exposed to the risks of inflation and economic instability. The need to reevaluate these positions is urgent, as continued reliance on fiat currencies without substantial gold reserves may lead to financial crises. The example set by China and Russia in accumulating gold highlights the importance of tangible assets in maintaining economic stability. Investors and policymakers must recognize the value of gold as a hedge against economic uncertainty. As inflation rises and bond yields increase, the stability offered by gold becomes increasingly attractive. This trend is likely to continue, driven by both geopolitical strategies and individual investment decisions. The shift in global financial dynamics necessitates a reevaluation of traditional views on money and value, with gold playing a central role in this new paradigm. Ultimately, the path forward involves a balanced approach that acknowledges the limitations of fiat currencies and the enduring value of gold. By learning from the strategic moves of China and Russia, Western nations can better prepare for economic challenges and ensure long-term financial stability. The ongoing global shift towards tangible assets underscores the need for a comprehensive strategy that integrates gold into the financial system, providing a robust foundation for future economic growth and stability.